This is an Uncovered Japan Company research report on Rheon automatic machinery, ticker 6272. Rheon invented the practical encrusting machine, the equipment that continuously wraps soft fillings and soft dough for foods such as filled buns, dumplings, and pastries. Today, it is a small Japanese specialist with a global food automation niche, a machinery business that carries the economic weight, and a separate food operation that both proves the equipment and adds volatility. This video follows the evidence from the research series: the product, financial record, growth plan, valuation, and the risks that can change the outcome. The headline valuation is straightforward. At the research date of 26 June 2026, Rheon traded on roughly 9.9 times forward earnings and 0.93 times book value, while offering an indicated FY 2027 dividend yield of about 4.1%. FY 2026 return on equity was 9.5%. Those numbers are not a recommendation. They frame the central question: does a sub-book valuation fairly reflect a high-margin machinery franchise with a strong balance sheet, or is it a durable discount for a small, illiquid company whose earnings can be noisy? Rheon's core product is easier to understand than its name. The company applies rheology, the study of how soft materials flow and deform, to automate foods that are hard to handle without tearing the dough or losing the filling. Its encrusting machines, bread and confectionery lines, ovens, and peripheral equipment sit at the heart of customer production lines. That makes the product valuable, not just as a machine sale, but as a labor-saving and food loss reduction tool. Once installed, it also supports updates, peripherals, and service work over a long life. The segment mix explains most of the investment debate. In FY26, food processing machinery generated 62% of external sales, or just under 26 billion yen, and roughly a 23% segment margin. The food products business generated the other 38%, but at about a 10% margin. Machinery segment profit rose 6.8% year-on-year. Food profit fell 16.9% after a major U.S. customer discontinued a product line, alongside yen strength and higher costs. The machinery engine is the trend, the food business is the main source of year-to-year noise. The financial record is materially stronger than the headline small-cap profile suggests. Revenue rose from 22.3 billion yen in FY21 to 42.0 billion yen in FY26, a 5-year compound growth rate of 13.5%. Operating profit expanded even faster, at a 29.8% compound rate, as the operating margin recovered from a 4.1% trough in FY22 into a 12 to 13% range. FY26 was a pause rather than a clean acceleration. Revenue grew 7.1%, while operating profit dipped 2.3% as food business costs and new plant startup spending weighed. Rheon's balance sheet is the cushion beneath both the investment program and the dividend. At FY26 year-end, it held 11.1 billion yen of cash, 2.4 billion yen of investment securities, and just 1.7 billion yen of interest-bearing debt, implying effective net cash of about 12 billion yen. Its equity ratio was 79.1%. This is not a leveraged turnaround. The trade-off is that a very large equity base limits return on equity. But the 9.5% FY26 ROE is still well above the trough and supports the case that capital is being used more productively. Cash flow deserves a careful reading. Operating cash flow remained positive at 4.5 billion yen in FY26, but capital expenditure rose to 4.6 billion yen, leaving free cash flow slightly negative. The cause was a visible growth bet, a new smart factory pilot, and Orange Bakery capacity expansion, expected to begin operating in April 2027. That makes the cash flow dip different from a balance sheet problem. The test is execution. When the plant is complete, capital expenditure should normalize, but the return on that investment has to be demonstrated. In a made-to-order capital equipment business, backlog is the most useful forward indicator. Rheon's food processing machinery backlog stood at 12.249 billion yen on 1 April 2026, up 19.7% year-on-year, and about 2.6 times its fiscal 2020 level. FY26 order intake reached 28.101 billion yen against revenue, giving a book-to-bill ratio of about 1.08 times. This is not guaranteed future profit, but it provides unusually tangible visibility. The main signals to watch are order intake, backlog conversion, and whether softer Chinese large project demand is offset by recovery elsewhere. Rheon's plan is built around automation demand and a new capacity base. not a financial engineering story. Management has stated targets of operating margin above 13% and ROE above 10% once the new plant is fully operating. The United States remains a key machinery market, while India, the Middle East, and Africa are longer-dated frontiers as diets westernize and factories seek labor-saving equipment. The company also benefits from Japan's labor-saving investment subsidies. Yet a successful narrative requires more than a backlog. The plant has to ramp smoothly, material and energy costs must be contained, and the food business needs to stabilize. Valuation is where the quality and the risks meet. Rheon's forward price-to-earnings ratio of 9.9 times sits near the bottom of its own recent range, which has generally been about 8.7 to 12.8 times, aside from the FY22 margin trough. It also trades below book value. Against the broad prime machinery sector, that is a deep discount. Against small food machinery peers, some of the discount is structural. The honest issue is whether the combination of thin liquidity, FX exposure, food segment volatility, and low buyback activity deserves a permanent discount. The research series uses author estimates, not company forecasts, to make the range of outcomes visible. Its 3-year bear case is 847 yen, or 43% below the then current price, if margins weaken, orders slow, and the valuation remains depressed. The base case is 1,895 yen, or 28% higher, on modest revenue growth, a return to roughly 13.5% margin, and only a partial re-rating. The bull case is 3,335 yen, if overseas machinery and the new plant perform strongly. These are scenarios, not targets. The important point is which operating indicators make each one more likely. Rheon combines an unusual product moat with a balance sheet that can fund its next growth phase. The core machinery business has a record backlog, healthy segment economics, and structural demand from labor-saving automation. The valuation is low, but the discount has real causes: a small and tightly held stock, an uneven food business, FX sensitivity, input costs, and unproven returns on new capacity. That makes this a monitorable research case rather than a simple conclusion. The next evidence will come from order trends, the food segment, margin discipline, and the April 2027 plant ramp. For the full analysis, continue with the free Uncover Japan deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.